Good morning, everybody, and welcome to the Nedgroup Investments quarterly fund feedback session today. Today marks the first of our 5 sessions this week. We'll be covering the cash solutions business. Tomorrow we'll have Ian Anderson talking about our property fund. That'll be in the morning, followed by in the afternoon we'll have Anne Sedgwick on the Rainmaker and Entrepreneur Fund. On Thursday, we have our stable fund report back, and then on Friday, we have our balanced fund report back. I'm Ian Ferguson. I'm the co-head of cash solutions for Nedgroup Investments, and I'll shortly be joined by Ray Wallace, who's the CIO of Taquanta and our best of breed manager. Ray and his team have been responsible for managing our cash product since inception, which goes back over 15 years now. Just a little bit on our cash business. Throughout this whole lockdown period, we've really operated very efficiently. Our clients have been able to transact as per usual, be it money market funds, which are obviously available every single day, and our core income, which operates on a T+1 basis. High levels of liquidity have been maintained in the funds, and we've had really good flows into our funds. To date, and that's from 1 January till the end of June, we have a net inflow of 40 billion rand. And I think what's important about this 40 billion rand inflow, that it's created scale in our business. And I think scale when it comes to fixed interest funds is critically important, thus ensuring obviously proper liquidity for all our clients that transact on a daily basis. So with that, I would like to hand over to Ray. Ray, thank you very much. I think you guys at Taquanta have done an amazing job for us, delivering above benchmark returns since inceptions. And I really want to thank you for that. So over to you, Ray.
Thanks, Ian, and good morning to everybody out there. Good to be with you again. Sorry it's not in real life, but we carry on. So, Sean's said quite a lot that I wanted to say already anyway, but I'm going to give you a sort of an overview of what's happened in the funds. It's been a very busy period. Our staff members are extremely stressed out at the moment. I mean, it's very difficult working in this new environment. A lot of people working from home and only a very few in the office, and the cash business is at the end of every single transaction that happens in the country. So we've really got to be on our A game all the time. So it has been very stressful over the last few months, but we've been able to keep it together. And as Ian says, the assets have grown substantially, and I think that's just really an indication of the responsible way that we've been able to manage these funds. So let's get started. I'm going to take you first through the portfolio performance, and then we'll go through portfolio positioning. I'm going to have a rate outlook, and then we'll talk a little bit about inflation. And then I wanted to just mention something at the end about the importance of ESG and how that's going to affect the future of investing, including some of the cash funds. Next slide, please. So the 4 funds that we're going to be talking about today are the 3 money market funds and the core income fund. Prime money market fund is a relatively new fund, so you'll see on the performance slide it has a less of a history, but we'll go through the rest of those. Next slide, please. Right, so looking at the actual performance of the funds versus benchmark, and the benchmark for the money market funds is the Steffi Call. And you can see, I mean, on a 1-year rolling basis, Steffi Call was at 6%. We're now down to 3.5% on call balances at the moment. So there's been a substantial decline in interest rates over the period. But as you can see, all of the funds have outperformed the benchmark quite substantially. And if you look at the corporate money market fund and the traditional money market fund, you're looking at about 150 basis points above call, which has been substantial, and we've been able to maintain that gap over the period. So that's been very useful for our clients to be able to get extra alpha out of that. The prime money market fund is still growing, but it has been able to maintain very well. I mean, that fund only has international rated single A and above rated instruments in that portfolio, so you would expect it to have a slightly lower yield, but it has still managed to maintain very well. Next slide, please. So looking at the core income fund, I mean, that has really been a phenomenal investment over the last few years in its ability to outperform the benchmark, as well as to be able to give you real returns. And these real returns have been quite substantial. I think at one point it was in the region of 4% above inflation. And we've been able to to maintain that pace. So again, this is a fund where we, if you compare it to Steffi Composite, and obviously Steffi Composite is almost 100 basis points above the call rate on a 1-year rolling basis. This is done particularly well. And through the whole through the whole COVID crisis and the downgrade, we haven't had a blip in the fund. We've been able to maintain it. We kept the performance going, despite the fact that we went very conservative, and we kept a very high level of liquidity. So the yield stood up very well against any of the competition out there, including some of the funds that took much higher risk. And obviously, we didn't have any issues during the COVID crisis. We'll go through the credit a bit later, but I just have to mention the fact that we avoided the whole land bank issue, because we had the ability to get our money back from Land Bank in January. There was a breach of a covenant on a loan that we'd had with them, where we insisted on having a management change covenant, and they had a number of management changes. So we managed to get our money back in January, because we noted that there were quite a lot of issues at the bank. So we avoided that entirely, which is, it says a lot about our credit process. Next slide, please. Now, during the crisis, there were a number of rate cuts, and I'm just to kind of show you, we sent out information regarding how the funds would act over the next 3 months, and this is kind of just to show you that we're pretty much on track with where we actually predicted the rates to be. So if you look at this slide and you see, at the beginning of the last rate cut, 50 basis point rate cut, we were at 5.63 on the corporate money market fund. We predicted we would go down to 5.08. We're currently at 5.22, and there's a few more weeks to go within that process. So we think we're spot on with that prediction. And if you go to the next slide, you'll see on the core income fund, it's a similar sort of process. We're down. We predicted we'd go down to about 560. We're currently at 565, and the rate of decline is slowing. So we think we're going to end up around that process. And if you look at the gap between where the fund is yielding compared to where call is yielding, I mean, there's a 200 basis point, more than 200 basis point gap over there. That is a substantial amount of alpha if you think about wanting to maintain a real growth in your assets, even if you're in cash. And with the volatility that's in the market, I mean, obviously you've seen the equity market flying, but again, you got to get a little bit concerned as to what are the reasons for equity markets doing so well. This V-shaped recovery in an environment where we saw some really bad news come out, you got to be a little bit skeptical. So if you are concerned, then cash is still, if it's able to give you a real return of over 2%, that's not such a bad deal. Okay, next slide. From here, I'm going to take you to the portfolio positioning, just to show you the kind of credits and the spread of the instruments and stuff that we go through. So looking at the three money market funds, you can see a distinct difference over here. So but the traditional money market fund, which is in the dark sort of black color, versus the corporate money market fund, there's less of a difference. Obviously, the corporate money market fund is more conservative in that it only has big banks and international banks and government paper. So we have some treasury bills in there. The traditional money market fund has theoretically a little bit of an exposure to corporates, but as you'll see through there really isn't much corporate. I mean, that Impumelelo is guaranteed by ABSA. You've got a little bit of Investec. I mean, the only real corporate in there is Mercedes-Benz, and that's AAA rated. But then you can see the distinction between that and the prime money market fund. The prime money market fund is really geared towards investors who are concerned about exposure to South African assets, and that may be insurers who get penalized for holding South African assets versus internationally rated assets that are single A and above. So they would get some sort of capital relief from having assets in the prime money market fund. And as we've seen before, the yield on the prime money market fund is not that much lower than the rest of the fund. So it's been a very good investment for insurers and people that don't want full exposure to the South African market. Next slide, please. All right, this is the credit exposure within the core income fund, and here you can see a similar sort of conservative approach to having big exposures to the big four banks, big five banks. And then if you look at the sort of instruments further along the channel, they're much smaller. And if you see where the green arrows are, that's really the only corporate exposure that we have. So we have a very small exposure to Transnet. That's the only SOE that we have. And we've been trying to look or to find a buyer for that instrument, but the market is very nervous about SOEs, so there are not a huge amount of buyers out there, and we don't want to just give the asset away because we don't think that Transnet is in the same position as some of the other assets like Landbank, Denel, Eskom, and that sort of thing. So we're happy to keep it, but we are looking for buyers for that asset. And then if you look at Mercedes-Benz, again, very small, Naspers on a CLN, and then Taquanta is SA Home Loans. So very good quality assets from that perspective. But really, we're still sticking to the banks in the core income fund and the other funds because we really want to see what's going to happen in the real economy over here. So there are some corporates coming to market, and there will be one or two that we do take exposure to. But by and large, we really want to see what happens because we think there's going to be a lot of turmoil coming through the corporate credit market, and we don't believe that the market is pricing that risk into the price of the instruments that we're buying. So we prefer to stick with the banks for the time being. There's still value in the banks. I mean, we've just picked up a credit-linked note with exposure to the R186 SA government paper that's from one of the banks, and we're doing that at Java plus 210, which is a really great asset to have. And so there are very good opportunities still within the banks, and we'll stick to that for the time being until the SA corporate market kind of shakes out the bad apples and then prices correctly for risk. Okay, next slide, please. Looking at the maturity profile, I haven't put the money market fund profiles up here because they're all less than 1 year, and it's a bit of a mix. But if you look at the core income fund, which technically can go out to 7 years, we have picked up a little bit of exposure in that space. But again, we're not going to be rushing into longer dated instruments in a very nervous market because that's where you have the potential for some spread risk. So we can continue to be relatively conservative. However, we have reduced our short-term high levels of liquidity, and we are buying assets out further into the 3 and 4 year area where there is some value to that. So I think in between the sort of first week in May and the first week in June, we've bought about 40 billion rands worth of new assets into our clients' funds, including core income and a number of other sort of segregated funds that we manage as well. So quite a substantial purchase, and we actually got them at really good rates. And I'll show you a chart just now as to there was a very short window to pick up very good rates on these assets, and that window is closing at the moment. But we did very well because we were sitting on a whole pile of dry powder in terms of cash that we had, that we were able to go and spend very quickly and pick up really good assets. Next slide, please. And just to show you the quality of the underlying instruments that we have in the fund, because you've got to remember, liquidity is not just the amount of cash that you have. Liquidity very much is around how liquid are the instruments that you have in your portfolio. How easy is it to liquidate those in a crisis and get your money back same day or the next day? And so you can see the huge exposure to negotiable certificates of deposit. These, in our view and in our experience over credit crisis in 2008 and the African Bank period, as well as now with the COVID period, the NCDs have been by far the best asset to hold in terms of a risk reward perspective if you wanted good quality of liquidity in your funds. So you can see the large exposure there to those assets. And then also in the money market funds, what has been a great asset is step rate notes. What happens in those assets is the longer you hold them, the higher the rate goes in terms of the spread that you get. So you go from Java plus sort of 80, and then the next step up goes to Java plus 100. Eventually, after 5 years, you can sit with something like Java plus 180 for a 3-month asset. And the real problem with those is to try and replace them after 5 years. You know what I mean? So that becomes a challenge for us. But at the moment, we're sitting on fairly high levels of step rate notes in the money market funds, and they become very, very competitive even with the income funds. Okay, next slide, please. I've just put this slide in here to kind of show you the amount of work that we've had to do to maintain the yield that we've got here. This is actually showing you, with the growth in the yellow line, with the growth in the market value of the corporate money market fund, you can see the changes in call balances. This is the amount of liquidity that we have in and out of the fund on a very regular basis. So the amount of work involved in managing a money market fund far exceeds anything that any of these equity guys do. You know, they get the high fees, but we do all the work. There's a lot of flow that goes through here, and you have to get every single cash flow right. We cannot miss a cash flow. People want their money same day, and there are large corporates in here who put huge amounts of money in and take huge amounts of money out, and we really have to be on the ball to make sure that we don't make any mistakes with this. And to date, we have not made any, and we're very proud of that. And we have a really good team of guys in our back office, in our middle office, and on the front office who make this happen every single day. Next slide, please. As I mentioned before, that period of us being able to buy assets into the fund, you can see this is a chart that shows the spreads on NCDs that we largely buy into these portfolios, and you can kind of see the periods that they go up and down. But you can see that in March with the crisis, the blowout in spreads that happened from March onwards, or from the beginning of March as it picked up, and we were able to pick up instruments at those spreads, that 30 or 40 billion that we've been doing. We've picked up at those higher spreads, and those spreads have now come off. I mean, it's very difficult to get anything higher than that. Although I put that dotted red line up there, we were actually buying assets at way above those spreads, because we just have because of our size and bulk, as Ian was mentioning earlier on, we have the ability to negotiate better deals than what the general market can show. So these are screen rates. We always say we don't deal at screen rates. So, you know, we are able to, with the buying power that we have, is negotiate a lot better rates. And you can see from the red arrow, those spreads have really come down now. So we did very well to pick up these assets at the time that we did. Okay, next slide, please. And this is really just an estimate of where a bank's spreads should be over time. And they're not at the moment short term, they've come back again, but we believe that these are the kind of spreads that we would be buying assets at the moment. So you'll notice that a lot of the income managers bought tier 1, the AT1 and the tier 2 debt. Those spreads blew out really badly during the sort of March, April period. A lot of them have come back quite strongly, but a lot of the income managers had a lot of problems with these assets. We don't hold any tier 1. We're allowed to hold tier 2, but we haven't bought any tier 2. We haven't held tier 2 for quite a while in the income fund, because we just didn't think the risk was worth the return. A lot of the income funds piled into these, and the spreads came down too low for our view on it, and we were vindicated in that during this crisis. Will we buy a tier 2? Well, we may look at it, especially when it comes down to shorter dated tier 2 assets, where we believe there's a very high probability that the banks will recall those, and there is some value there. So it's something we will look at, but the prices have to be right for those. Okay, next slide, please. Okay, so really that talks, you know, I've spoken about the portfolio and the performance and the positioning, and that really has been, in our view, a good story to tell over the last 3 or 4 months. The funds have done very well, but where do we go from here? If you're a holder of cash, where do you go from here? What is the prospect for cash over the near, medium, and longer term? So next slide, please. I'll discuss the outlook for where rates are going. So if you look at the forward rate agreements, and these are very liquid instruments that we guys and the banks and a lot of speculators in the market are trying to figure out where rates are going, and they take bets against these. So they're probably the best indicators of whether they're going to be rate cuts or not, regardless of what the Reserve Bank says. And occasionally we get it wrong, but effectively the market often is correct, in that you've got the combined knowledge and experience of the market into one instrument. And effectively what they're doing is predicting that there's the very high likelihood of 50 basis point cut over the next 5 months, next 9 months, and obviously the high probability of a rate cut coming up in July, and then again within the next sort of 6 months, 6 to 9 months, the other 25 basis points. Our philosophy has always been that we don't really, it doesn't really bother us too much whether there's going to be a rate cut this period or next period. It's the longer term approach to it. So we look at it and say, the Reserve Bank has the ability, we think, at this point in time to have some more cuts. So another 50 basis points over the next few months kind of makes sense to us. But because, we don't really want to take interest rate bets, we've always had the view that we have floating rate instruments. We're more concerned about the longer term, and at what point does the Reserve Bank get to when it says it can't do that. So if you go to the next slide, we look at where inflation has come from in June 2005 at 2.8%, spiked up during the credit crisis, and then come back down and sort of gradually come down to where we are now at about 3%. And it's intuitive. We've had very bad economy. There's no growth in the economy. The world has had no inflation. There's been a lot of quantitative easing, which has contributed to this whole process. But now we're in a completely different environment, and it's the intuitive view would be to say that inflation is going to be low for kind of forever at this point, because everybody's chucking money at the problem. There's not a massive amount of demand for everything out there, so we would expect inflation to continue. But if you go to the next slide and you look at the credit spreads that are inherent in especially in the emerging markets, if you look at Turkey, which is higher, so the credit risk, or not the credit risk, the country risk that the markets, especially the foreigners, are pricing in compared to ourselves in yellow, and Brazil in the purple. So the world is looking at us and saying there's more risk in South Africa than there is in Brazil, even though Brazil, from looking at what's happening over there, you would have expected them to have a higher risk premium. And if you look at our bonds on the long end, our bonds have higher yields than Brazil, which just, in my view, doesn't make sense. But obviously there's a concern out there as to what's going to happen to inflation and to prices and stuff over the long term. So foreign investors are looking at this and going, look, we can get really high yields over here, but we're actually not prepared to pay too much for that kind of risk. So if you consider that, and if we go to the next slide, and you then see what happened in the budget, in this recent budget over here, and you start looking at some of the factors over there. I mean, unemployment is going to fall off a chart over here. The red line is already gone beyond 30% from the previous one, and our real GDP looks like it's declining. So the argument there would be, because of that, you would have a disinflationary effect from that. But let's go to the next slide then. And we look at, say, for instance, the US. We're not alone in this whole process of having unemployment. So I don't think, in the recent past, we haven't had any experience of these kinds of changes to the economy and what effect they have long term. So what you do is you go back to your sort of recent past and say, well, if you have unemployment, then you're going to have lower inflation because there's going to be lower demand. And the same with the next slide. If you go to the next thing and you look at from the budget again, you look at our expenditure. So again, now this starts getting a bit more complicated, because what you were saying, there's going to be lower employment, our GDP is going to go down, but now we're going to have much higher expenditure. What does that do to inflation? We haven't had that experience before for a long time. So we start looking at this and saying, well, longer term, if you're having your expenditure increase by this amount compared to your revenues in an environment where there's sort of very low GDP and low employment, what does it do to inflation over the longer term? And if we go to the next slide, you can see we now have debt levels that are going to exceed anything we could possibly have expected before. Again, what inflationary pressure does this have? Okay, next slide. So in summary, we are less convinced that inflation is going to be low for longer. So our view is that interest rates over time, as much as they should really have come down, we think that the short end has actually come down too far, and that at some point we're going to see inflation come in. And so we believe that the short end of the market will pick up, and cash investments, cash rates will start picking up after a certain amount of time. I'm not sure how long that is, but we will start seeing those inflationary effects come through. Because if you look at the rand effect on imported inflation, and the rand has not really strengthened a huge amount. It's been sort of, in between that 17, 16, the high 16s, 17s. It hasn't really come back very strongly. It will depend on what happens to the dollar. You've seen the oil price movement. I mean, the futures went negative at some point. But again, there's still demand for oil. So it really depends on what happens to those prices longer term. We know there's Eskom electricity prices coming through. These are going to be large price increases coming through for extended periods of time. We've got municipal shortfalls. What's going to happen to rates and taxes? What's going to happen to the cost of services and things like that? And we're not seeing the drop in public sector wages. So we're going to have this continued high expenditure, and then we've got governments around the world that are printing money, and traditionally over the long term, when governments start printing money, you've seen what happened to our neighbor next door. The idea of inflation starting to creep back in and getting out of hand is not something that we need, that we should be ignoring entirely. So our view is that there might be more pressure on inflation going forward. Okay. Lastly, I just wanted to just mention something about ESG, because obviously it's become very important in the discussions of late, and it has to be, because we really need to do something differently. We can't continue to do business the same way that we've been doing for years, and everybody just rushing after return without taking the responsibility for what happens to that money in the background. Who are we giving this money to? What are they doing with it? Are they responsible enough to make sure that they're not churning out single-use plastic, or there's pollution going into the air or into our rivers and things like that? And really, we need to do this responsibly for our kids, and for the younger generation that are coming up here, that have inherited all of this thing. And we as asset managers have that ability, with the kind of money that we're looking after. We have that ability to make decisions as to who we give money to, and we have a choice not to give money to certain people, regardless of the yield that comes through from that. So, it's our responsibility to do that. So what might happen in the future is that you might see a focus towards excluding some investors or reducing exposure to certain investors, and not so much, just chucking everybody out and saying we can't do that, because in an environment like South Africa, we don't have the luxury to do that. What we do have is the responsibility to talk to the people that we lend money to, and actually start forcing that change on them by using the money that we have to create a change, and to create awareness amongst, I try and create awareness amongst the junior portfolio managers that I have, to take this seriously and to be passionate about it, and to say, look, you guys have got a huge amount of power. Use it wisely and use it for the future going forward. Do things differently to our older generation, where we just chased yield. You've got the ability to do it. All right, thank you very much. That's the end of my discussion. If we have any further questions, I think happy to take those.
Ray, yeah, that is fantastic. Thanks very much. Once again, you guys have done an amazing job for us over many years. We do have a couple of questions, but just to put in perspective what Ray was talking about, flows. And if you think that this business has had flows of round about 500 billion year to date in terms of gross and gross flows, and obviously paying out that cash to our clients every single day when they're required is critical. So it takes a really good team effort, and obviously the back offices and the front offices need to work well together. So Ray, thanks very much to you and your team. There are a couple of questions. One is was regarding working with the international banks to try and see how their funding's going, because historically I think a lot of the international banks were based in South Africa and they were issuing a lot of paper, and that seems to have dried up slightly. So how's that process going, working with them to try and, I guess, generate instruments? And coupled to that, I guess, also then working with the domestic banks in terms of, it seems like they're only looking for funding in certain duration buckets. And how do you work with them to try and get, I guess, the right assets for the fund so that we can deliver long-term performance?
So on the international side, it's been quite difficult of late, because obviously, without any economic activity going on within the sort of Southern African region, a lot of these banks, that was the reason for them being here, is to actually do a lot of corporate financing and stuff where they would need some sort of money to do that. So that's dried up quite a lot. I mean, they are still willing to work with us because they see the longer sort of picture, the longer term picture, and they're happy to still take money on the shorter end and stuff, but we find it very difficult finding assets that have some sort of term to them. But there are some of the banks that are willing to work with us, and I think some of them take it as a bit of a loss leader just to make sure that they can be competitive when things start picking up again. But obviously you've seen SocGen and you've seen Macquarie and a couple of other guys that have left the arena. And it just makes it more difficult for us. But we have very good relationships with the guys there. And as soon as things pick up, I think it will become easier, because we've got used to working with them and buying assets from them and talking to them about structured types of assets and things where if they need specific funding for specific projects and stuff, that they can happily come and speak to us, because we can take out an entire issue because we have the size and volume for that. So I think it's just a waiting game, and it's continue to build those relationships and chat to the guys in London or in the US and stuff about saying, look, if you are coming into South Africa, please work with us. So we continue to work on that. On the local side, obviously it's been very difficult for the local banks, because 1 minute in the beginning of March, they had, there was a run on sort of getting liquidity, because a lot of the fund managers had messed up their futures positions and they needed to cover short positions and things like that. So the banks were running ragged to try and create liquidity, and the Reserve Bank came in and helped them. But since then, all of this cash has flown back to them, so they're very reluctant to want to take a lot of cash, especially in the short area, and they've kind of, there's nobody borrowing money anymore, so they don't really need a huge amount in some of the longer areas. So it's been tricky, but obviously with the size and volume we have, it's much easier for us to sit down and have a discussion with them, and we know them very well, and we can actually talk to them and say, look guys, where is it you need cash? What can we do? Is there any other type of instrument we can do with you? Is there something? So that's been very good from our perspective in that we've, like I said before, we bought that 30-40 billion rands worth of assets in a very short space of time, and that was through the relationships that we had with the banks. At the moment now, I think it's a bit of a wait and see, and that's why we've seen the spreads come off. So again, we're talking to the banks all the time, and if anything does come up, we're obviously one of the first guys they call, and so that gives us a bit of an edge over the competition, and we can do that. Having said that, we have reduced liquidity levels, so we're comfortable. We're not rushing out to go and buy assets at the moment unnecessarily. We'll wait for the good ones to come around and do that. So we continue to work with the banks.
Yeah, thanks, Ray. And then another question popped up is, you've looked at the instruments you've bought within the funds, and the one that has popped up is step rate notes. Maybe just explain how step rate notes work, because I think it's quite it's a good investment for a money market or a core income fund.
Okay, so especially for money market funds, one of the biggest constraints that we have is the final term to maturity. So you're not, sorry, let me just kill this. In a money market fund, you have this limit of a final term to maturity. So you can only buy assets that are 13 months or shorter. And obviously, if you buy a 13-month asset, it then affects your duration limit, which is 90 days, because obviously you've got a 365-day asset, but you need, your average of your portfolio needs to be 90 days. So it uses up a lot of that limit. So years ago, we were doing structured products for a number of our clients, where we had like a fixed rate for the first period, and then we had a floating rate for the remaining periods for the next 3 years or 4 years. We went to one of the banks and we said to them, can you do something different for us? Can you take an asset and then create, let's say, a 5-year NCD, which would be impossible to put into a money market fund, and could you create us an instrument that then says your final maturity is 3 months, but you have the option to extend it for another 3 months, every 3 months. Now what it does is it gives you an asset that you can hold for 5 years, but it fits within the duration limit. So we can get our money back after 3 months. The bank takes that risk on it, but the spread that you get, you take just roughly, you take a 5-year spread. Let's say it's 150 basis points for a 5-year floating rate asset, and then you say, how do I take that 150 basis points on a PV basis and apply it to a 3-month note? So, and to encourage you to hold that note for 5 years, because the banks want you to stay in this instrument for 5 years, even though you can give the money back in 3 months. So what they do is they then take that 150 basis points and redistribute it amongst the 3-month instruments that you now hold, or that you could potentially hold. And then they say, okay, right, on your first 3-month period, we will give you Java plus, let's say, 80. On your next 3-month period, you can have Java plus 100. On your next 3-month period, it's Java plus 120, and so on and so on and so on. So by the time you get to the 5-year period, you are at Java plus 150 or whatever the spread was on it. And so it benefits everybody, because the bank retains your money for a longer period than 3 months, because you now sitting on an instrument, you don't want to sell this thing, because 2 years into it, you're getting, for a 3-month instrument, you're getting Java plus 120 or 130. So you don't want to sell it, but you could if you needed to. And it fits all the requirements of the CISCA regulations. So you now, the longer you hold it, the more competitive you become compared to other money market funds who are actually going out and buying just a normal 3-month instrument at Java flat. You now have got an instrument which is also 3 months, but it's Java plus 120. So this is the reason why we would buy as many as we possibly could in these portfolios if we could get our hands on them. And being a bigger fund in the market, we are able to pretty much get our hands on whatever's available when it becomes available. So we think these are great assets, and obviously it's only with the big 4 banks, and we really enjoy those assets, and they've been great for the portfolios.
Great. And then final question, Ray. It seems like during the tricky part of March, April, there was quite a lot of sort of secondary assets or secondary market assets that came to the market. Traditionally, you've always been the primary market, and just tell us how were those spreads, and did you manage to acquire quite a bit of that type of paper?
Yeah, I mean, the spreads blew out. If you take, I think before the crisis was around, for a 5-year instrument, was around about Java plus 125, something to that effect. When the spreads blew out at their worst, selling a 5-year instrument on the secondary market was in excess of 200, Java plus 200. So, but that was around for a very short space of time. Those were the guys who really were forced to sell. The banks themselves had increased the spreads to about Java plus 160. We were getting it a little bit higher from some of the banks at that point. But in the secondary market, we managed to pick up a reasonable amount. I would probably say sort of just over $1 billion, maybe a bit more than that, in the secondary market, picking up sort of opportunistically, picking up these instruments at really nice spreads above 200. But again, as things calm down, guys are not going to be selling it for quite as low. But you needed to have cash around, and you needed to have the ability and the capacity within your portfolios to be able to do that and go out. And it was fairly scary times. You were a bit nervous about going out and buying assets at that point, but it was the right time to go and buy those at those kinds of spreads. So unfortunately, we would have loved to have got sort of 20 billion worth, but we took what we could at the time. But there were some very attractive spreads.
Great, Ray, thanks very much. That's fantastic for that comprehensive report. We really appreciate it. Guys, for everyone who joined us on this call, we really appreciate your time. And just a final reminder that tomorrow at 10 o'clock, we have Ian Anderson talking about the Nedgroup Investments Property Fund. And then in the afternoon at 4 o'clock, we've got Anne Cedric from ABAX talking about the Entrepreneur and Raymaker funds. So yes, once again, thanks for joining us. Have a great morning wherever you are. In Joburg, it's quite nice and brisk. I believe Cape Town's heading for some rain quite soon, which is a good result. But yeah, have a good one and enjoy your day.